Hey everybody, this is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, December 21st, 2024. How you doing? I appreciate you coming to my weekend review podcast. I hope you had a good week. I know we had kind of a crazy week in the markets, and definitely some sellers came to town. But that's how it goes. We get used to things just going up and up and up, but there is a give and take to the market. So I will be talking about that today in addition to the other topics that I cover. We will be taking a look at the indexes as well, the SPY and the Qs, because there was some technical damage done to the market, and we'll get into it and try to explain it. But the podcast format for today is, first of all, we're going to run the U.S. legal disclaimer. Secondly, we're going to come back, we're going to take a look at all the positions and all the trades that I made last week, both the open and the close, both on the daily time frames and the weekly time frames. We're going to talk about when I enter the trade. We're going to talk about why I enter the trade, what the signals were, what the confluences were um, of why I entered the trade, and then we're going to talk about how I am going to manage the trade going forward. We're going to talk about how I position size correctly based upon the volatility. We're going to talk about where I place my emergency stops, where I place my end of day stops, how I'm going to take partial profits into the trade if it starts to go my way. And then we're going to talk about major overhead resistance levels and different rules that I have of when I completely exit the trade. So I hope that's going to be helpful for you, kind of give you an idea of how I take a look at trading, markets, entries, exits, and hopefully you're going to learn something good. After that, we're going to talk a little bit about trader psychology. It is the most important skill in trading, the ability to create a plan and follow the plan. If you want to make money in trading over the long run, you just have to come up with a decent plan, whether the strategy is one of the strategies that I use or something else that you use. There are many strategies that work, really, but they don't work unless you use them. And that's really what it comes down to, is the ability to create a decent plan that, where you're buying at support, you have signals that get you into the trade, but then following the trade. It's so important. It really, it's just like losing weight. We all know how to lose weight. We eat less food, we eat better food, we exercise, and it works. We know how to do it. It's the same with trading, but it's difficult for people to lose weight and to follow their diet and exercise plan. They know it works, but they still don't do it. It's the exact same thing with trading, everyone. So, if you want to stay in this game, if you want to make money in this game, over the long run, get yourself a plan and simply stick to it. If I can help you in any way, please let me know. So we'll talk a little bit about trader psychology. Hopefully that's going to be helpful as well. And then every Friday I go through my master watch list, both on the daily time frames and the weekly time frames, and I look for different potential setups for next week. Now they're not where they need to be for me to buy them yet. So the trade has to come to me. It has to get to the level that I am interested in. And what am I interested in? I'm interested in levels of support. I'm interested in multiple confluences of signals happening at the same time. And I have identified those. I will go down through each one and explain what I'm looking for and say, look, if it gets down here and does this and this and that, then I will consider taking the trade. But in my experience, and I've traded for over 29 years, the best way to have good trading positions is just to wait, be patient, let the trade come to you. And even if it does come to you and does exactly what you want it to do, of course, there's no guarantee that it's going to be a profitable trade, but it increases your chances, increases your odds. And that's what it's all about, everyone. Not every trade's going to work out. Hey, listen, this week I had a lot of trades. I had a lot of losing trades. And I'll show those to you, but the taking partial profits when I had them, you'll see why that is such an important component of my trading. Really, truly, this is one of the best weeks of showing you why that was so important. And, if you listen to this podcast, you realize that I always play offense and defense in my trading, and you'll see why that offensive part was so helpful. So we'll go through those when we get to the trades. But essentially, that is going to be the podcast. So I hope it's going to be helpful. If it is helpful for you, I would appreciate if you could hit the thumbs up button. It really does help the channel, lets YouTube know that there's some valuable content here, and just helps it out a lot. And if you haven't subscribed, I appreciate it if you would subscribe too. And again, I'm still here in Santa Marta. Really love it here with my girlfriend. Her daughter came to visit, so it's been really nice. It has been a really nice trip, and boy, nice and warm. And I think about being back home where I live in Utah. Oh man, I really don't want to go back. And that's the nice thing about trading. You can trade from anywhere. So listen, we're going to run the U.S. legal disclaimer, get that out of the way, and I'll be back in about 40 seconds, and we'll get started. Thank you.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
Okay, thanks for holding through that with me, and let's get started. Let's start with Intel. This is on the dailies. And you can see this green box here, and this is an important area that I was waiting for the price to get to and reject. It is down on, but we had a nice reversal back on Friday. But let's first talk about why I took the trade. So I took the trade here on the 10th of December at $20.15. But let's talk about why. So this green box here, we go all the way back to the 7th of August, and you have the lowest close here on the 7th of August. You have the lowest close. This was the lowest close here at $18.99. So why is that important? Well, this was the lowest low close before we had a structure change, and the structure change came here on the 15th when we broke above that previous high. So we went from a downtrend to an uptrend. So I don't buy that breakout. That's kind of a breakout buy. After the breakout to the upside, the structure change to the upside, then I want to buy the dips back into the bullish order block. And if we go back to a previous trade back here on the 11th of 9/11, I took this trade here because, again, we had the lowest low close before we break structure to the upside. Then we came back in. I got a signal here on 9/11 and rode that from about 1949 up to 2345. If you watch the podcast, you remember that trade. Well, now the reason I took it again is because, and then we ran higher, and then we've come back into that bullish order block, and these order blocks tend to have memory. So when they get back there again, I'm looking to buy again. So I did buy here at $20.16 on the 10th of December. Now, when I buy something, the most important thing, we talked about this last week on the podcast, is the position sizing. It is the number one crucial element of trading is your position size. Because if you have a great trade and you go all in on this trade, it doesn't matter how good the trade is, it can still go against you. So let's talk about position sizing first. So it first has to do with how much money you have in your trading account. So let's just say you have $50,000 in your trading account. So what I do is I take 1% of my trading capital. 1% of 50,000 is 500. If I have 100,000, 1% is 1,000. If I have a million, 1% is 10,000. So for this example, let's just say it's $50,000. 1% of that is $500. And then the next thing I want to look at is the average true range. The average true range is $1.83. Average true range just means the average it should move on any one day. Well, I take that number and I times it by 2, and that is 183. So if I'm in a trade, it should not move against me 2 ATRs. And if it does, there's something significantly wrong and I want to get out of the trade. So the 1% of the $50,000 is 500 divided by the value of the 2 ATR, 1.83. That's telling me, based upon a $50,000 trading account and the volatility of the market, the ATR being 183, I should buy 273 shares. So let's buy 273 shares at $20.16. Now, after I make the trade with the correct amount of position size, that like I just mentioned here, I take my entry price minus the 183, the 2 ATR 183, and I put that below my entry price down here at 1837. So that is my emergency stop. So most of the time when I have a losing trade, it is because my end of bar stop has hit. And I wait for the end of the day, because the end of the day is the most important time. That's when the large financial institutions come in at the end of the day. They're dealing with the most money. They have very smart people, the best technology. So the end of the day close is the most important. So most of the time I want to wait to the end of the day to make my decision to stay in or to get out of the trade. But with the emergency stop, if it hits my 2 ATRs, I don't care if it's 5 minutes after the market opens or 5 minutes before the market closes. If it gets to my emergency stop, I do not wait for the end of the day, because if I get to my emergency stop, then I have lost 1%, right? So if I buy at 2016, I put my 2 ATR emergency stop at $1.83, and I have 273 shares that moved to $1.83. How much have I lost? I've lost $500. So, but the good news is that only happens about 5% of the time. 95% of the time, if you have a loss, it will be because your end of bar stop. So, uh, got into the trade here at $20.16 when it got into the bullish order block. In addition, on that particular day, we went under 30 and over 30 on the RSI. So that was the confluence of signals. When I take a signal, almost always, not all the time, but more times than not, I have two signals. So the signal of entering this trade was one, we went into the bullish order block, and two, we went under 30 and then over 30 on the RSI. So that was the confluence of signals. That's a deep dip buy. That's one of the strategies that I use. But I combine a lot of stuff. I'll combine a order block with a deep dip buy, or I'll combine an order block with a double bottom and a bullish divergence and a V1 or a V2. So it's all about the combination of and the confluence. So on that day that I got in, we got into the order block and we went under 30, over 30. Okay. Position size correctly, like I just mentioned. I placed my emergency stop 2 ATRs below, and my end of bar stop is simply a close below the 30 RSI. And so, and that hasn't happened yet. So, have the entry signal, place the emergency stop. My end of bar stops are closed below the 30 RSI. The next thing I do is I place what is called a trailing stop level 1.5 ATRs above my entry when I enter the trade. So on the day that I entered here, I look to the 1.5 ATR, which is $1.37. I take my entry price and I add to it 1.5 ATR. So that means when I enter the trade, if it ever gets to my 1.5 ATRs, then I go into what is called trailing stop mode. This trade has not done that yet, but I'll show you others that have. And all that means is when I get to the into the trailing stop mode, then in the future, if I have a close below previous bar's low, I'm going to get out of half. Okay, now I talked about playing offense and defense. Everything we've talked about so far, position sizing based upon your account size and the market volatility, placing your emergency stop 2 ATRs below your entry, having your end of bar stop. In this case, I got in primarily because the under 30, over 30, therefore if it closes under 30, I'll get out, and placing 1.5 ATR trailing stop level above. These are all defensive moves. In other words, if the market goes against me in any way, I'm going to I have a rule that I have to do something and get out. That's all defensive. But I also play offense in my trading. I also play offense in my trading. So the way that I do that is that I take the closing price of the day, 1950. So I'll give you an example for Monday. We take the closing price of the day, 1952, and I add the value of the 0.45 to it right now. And as we go through more trades, this will all kind of come together. So we take the closing price, 1952, plus the value of the 0.41, plus 0.41. My first profit target for Monday is 1993. And I'm going to place 3 profit targets. So the first one, just taking the closing price plus the value of the 0.45 is 41 cents. So 1952 plus 41, 1993 is my first profit target for Monday. Then I take my first profit target, 1993. I'm going to add the 0.41 to it again. And the second profit target for Monday is $20.34. Then I'm going to take that again, 2034 plus 0.41. My third profit target for Monday is 2075. So that is the offensive part. If it moves the value of 0.45 ATRs from the previous closing price, then I'm going to take off 10% of the remaining shares that I have. So, and I'll illustrate this here. So, big picture now. Entering the trade into the bullish order block, under 30, over 30. I position size correctly. I place my emergency stop 2 ATRs below. My end of bar stop is simply going to be a RSI close below 30 RSI. I place my 1.5 ATR trailing stop level above so that if I get there, I go into trailing stop mode. And I'm off on the trade. So the next day, nothing happens. Here on the 12th, it did move the value of 0.45 ATRs from my entry. What did I do? I took off a partial profit, right, at profitable levels. Reduced my position size. I locked that in. The market can't take that away from me anymore, right? And so I just locked that away a little bit, put that in the bank. The next day doesn't do much. The next day here on the 16th moves up again. So I think I hit another profit target, at least one. I know I hit at least one. Took that away, locked that in, reduced the position size. So again, if it moves the value of 0.45 ATRs from the previous bars, from the previous day's close, I take partial profits. I take something while the market gives them to me. So then the next day we had an inside bar. It was down, no profit targets. Then we hit that huge sell-off on the 18th. That was just gnarly. Came down, did not close below the 30 RSI, barely stuck in there and held above the 30 RSI. Otherwise, I would have had to have gotten out. And then next day down again a little bit, but still held above the 30 RSI. And then Friday, of course, we had the rally on Friday where it moved up. And I did take off I hit another profit target. Although this one was below my entry price, but that really doesn't matter. If I'm underneath my entry price and the market still gives me something, I'm still going to take something. So this particular trade at the moment is down 3.23%. But can you see why taking that partial profit at least helped mitigate this loss? Because I took 10% off here, I took 10% off here, and right now we're at 34.66. So if it closes under 30 RSI, I'm out of the trade. Alternatively, Monday, if we go down and I just hit the profit target, then I'm simply out. So yeah, a tough week here trading, obviously, for a lot of people for if you were long, and that's just how it happens. You know, the market really did go up strong. People were kind of throwing caution to the wind, and that's really when you really have to be even more careful. So I'm glad I had some shorts as well. So the remaining shares on Intel down 0.32%. Okay, but still in the trade. Sprout Fresh Market, SFM. Okay, well, this turned out to be a really good short. of mine, and I did short here on the 12th of December at $149. So this is a different, well, it's not different actually. It's the same as the bullish order block. It's just the bearish order block here in the blue area. So why is this a bearish order block? It's because we had a high followed by another high. And then here on the 9th, we had this big breakdown where we took out this swing low. So we went from a bullish market structure to a bearish market structure. So just like I showed you with Intel, when you have that memory block there of the bullish order block, well, now we have a bearish order block. And again, we have a high followed by a high. We break structure to the downside, and then we went up here and we rejected this bearish order block here, and I got short at 149. So what do I do now? I position size correctly, the way we described, 1% of the capital divided by the 2 ATRs. I place my emergency stop 2 ATRs above my entry because I'm short, and then my end of bar stop is simply a close above the high of the order block here at 154.16. I place my trailing stop level 1.5 ATRs below, so that if I get into trailing stop mode, then I exit half of the position if I have a previous close above, because I'm short, a close above the previous bar. But that hasn't happened yet. So again, got short here, 149, because of the rejection of the order, the bearish order block after breaking market structure. And the next day we went down a little for one profit target. The next day here on the 16th, we had a big crackdown where I hit multiple profit targets, and now I'm at trailing stop level. And again, all that means now if I have a close above a previous bar's high, I'm going to get out of half of the remaining shares. Next day down again substantially, which was good for my short. Next day down again, taking profits. Next day down profits. Thursday we didn't do much, and then down again on Friday. Now, the key point here is that, I mean, obviously this trade has been tremendous, but we are at a 33.94 RSI level. If I'm short and we ever get to 35 RSI level or below, then if I have a close above the 5 EMA, I'm going to get completely out of the trade. Here's the 5 EMA right now. The 5 EMA is at 136.52. So essentially, going here into the future, if we close above this 5 EMA, I'm simply out of the trade. If we go lower and reject the 30 RSI, then I will take off half of the position. And then if I have a close above a previous bar's high after rejecting the 30 RSI, I will get out of the entire trade. And if you're new to the channel, I know this all sounds pretty complicated, doesn't it? All these rules, but really it's not. And I do teach private one-on-one lessons in the evening time via Skype. I teach a 15-hour course where I teach you all 7 of the different trading approaches that I use. Like I said, I've been trading for over 29 years. I have taught absolute beginners all the way up to the hedge fund level. I love to teach, and what I teach, all these different trading approaches, they're all the type of trading strategies that if you use, you are going to be a successful trader if you use them correctly over time. So if you're interested in studying with me, I think one-on-one is the best way to learn anything. And so if you're interested, my email is in the link in the description. Send me an email. We can have a Skype call. It's not a sales call. It's just to get to know each other call. You can ask me questions about the course and about the format, and then I can ask you some questions about you and your trading and your challenges and your goals. And you'll have a nice skill that you can use for the rest of your life. So send me the email, and it'd be nice to talk to you. So again, here we are, 33.94. Again, if it closes above the 5 EMA now, I am simply out of the trade. If it keeps going lower, I'll continue to take partial profits until it rejects the 30 RSI. Then I'll get out of half. And then after that, if I have a close above a previous bar's high, then I will completely exit the trade. But this short trade really has been a monster. I mean, it's up 13.20%. And the key here is just waiting for my rules to get out. It could just keep going down. You just never know. I can't think to myself, oh, this is low enough, I'm just going to get out. Wait for my signals. Again, if it goes up and closes above the 5, that takes me out. And if it goes lower, continue to take profits, rejects the 30 RSI. Well, if I wasn't short and it rejected the 30 RSI, then I would be looking to potentially get long. So if that happens, I certainly would take off more of my short position. But thankfully, on a week like we had, I'm really glad that I had this up 13.20%. Okay, so those are the two open trades at the moment. Intel down 3.23%, and Sprout Fresh Market SFM on the short up 13.20%. Okay, let's get to the close trades that I had last week. Excuse me. Okay, so this is TLT. And at the beginning of the podcast, I was telling you about why the rules that I have are so important. Now, this trade I got stopped out of right near the lows, but the important thing is what I did before I got stopped out. So let's talk about why I entered the trade in the first place. So I entered the trade here on November 15th at $90. Why? Okay, look, here is the bullish order block, the green area here. We have to go all the way back to May 29th. It was your lowest bar close before market structure change. And you can see it changed structure here by going above this high. At this point, you want to buy the dips. Well, that was a good dip to buy. That was certainly a good dip to buy. But remember, going out into the future, these prices have memory. And even here on the 6th of November, we touched the bottom of that order block. That's exactly where we bounced. I didn't take this trade, but I did take the next trade when it rejected the order block at $90. One, because it rejected the order block, and two, because we had a double bottom with the bullish divergence, meaning this down move here corresponded to these big, deep red MACD bars. The MACD is momentum indicator. But then we rallied, and then we came down here on the 15th. We are just as low here as we were back here. We're lower than here, but look how there was no red MACD bars. This is called the double bottom with the bullish divergence. Really, all this means is that the momentum is the downward momentum is slowing, because here we have no red bars, where here we have tons of red bars. But this indicates that we should have somewhat of a bounce. We're running out of sellers. And if you run out of sellers, the implication is you are going to move higher. So the confluence was a double bottom with the bullish MACD divergence, a rejection of the bullish order block, got long at $90, position sized correctly, placed my emergency stop always 2 ATRs below, and my end of bar stop is simply a close below the bottom of this green box here, the order block at 88.68. I placed my 1.5 ATR trailing stop level above, and of course, as always, if it moves the value of 0.45 from the previous bar's close, I'm going to get out of half. Next day moved up a little, not enough for a profit target. Next day did move up, took off a little bit of profit, and you'll see every bit of profit that I took off on this trade. You'll see how important it is, because look where it ended up here, right? So then we moved sideways and we had a huge move up. I was able to take 3 profit targets on this day, 30%. It's important, super important now that it closed this low, right? So I was taking profits into the strength. In addition to taking the 3 profit targets on this day, I also reached my trailing stop level. And trailing stop level just means now that I'm in trailing stop level, if I have a close below previous bar's low, I'm going to sell half of everything that I have. Next day we moved down, didn't do much. Then we had another up move, took more profit targets. Next day moved up here, more profit targets, some sideways motion. Then we moved up again, more profit targets. And then here on the 9th, I had my first close below a previous bar's low after reaching trailing stop level. And I took off half of everything that I have right near the top, thankfully, right? And then we just have this down move. No profit targets, no nothing, no nothing. And then here on the 19th, we closed below the low of the order block. I had to get out of the trade on the remaining shares for a loss of 2.48. But think about it. This was still a profitable trade for me. Can you imagine that this was a profitable trade? Why was it a profitable trade? Because I took off profits into strength. Every time it moved up, I took off profits. I took off profits. Here, I got rid of everything near the, or half of everything near the high. So can you see how important the taking off profits when the market gives you something, especially if you have this huge reversal like this that happened. So the remaining shares on this were down 2.48%, but you can see I took half here when it was up 3.69%. So anyway, I hope this is a good illustration of why I incorporate the defense and the offense into the rules. So, but the remaining shares here down 2.4% on TLT. Okay, so out of that one, WBA. All right, a lot of bullish order blocks. Okay, WBA was a great trade, very similar to the Intel trade where, look, here we are again, bullish order block. I got in the trade on the 21st of November at $8.31. Why? Bullish order block. Here on the 25th, your lowest bar close before market structure change. Okay, market structure changes. If it gets back to the order block, I want to look at getting long. And that's exactly what I did. Got long 831 because we got back in the order block, bullish order block, and also we had a V1. A V1 is an entry signal. Takes two bars. Here is bar 1, here is bar 2. On the day that I entered, it went below bar 1's low and then closed above bar 1's close. Also rejected the order block. And by the way, if you'd like to learn more about V1s, V2s, I have a video on YouTube in the lessons playlist. Check that out. I think that will be helpful for you because I use V1s and V2s all the time. And then, so I got long 831, have my trailing stop level 1.5 ATRs above my entry at 887. And now I'm whatever happens to the market, I know what I'm going to do. If it goes up, I'm going to take partial profits. If it closes below the order block, I'm going to get out of the trade. If it goes crashing down, hits my emergency stop, I know what to do there too. Just get out of everything. So the next day moved up nicely. I believe I hit 2 profit targets right off the bat, took 20% off. Next day moved up another strong move up, took more profit targets, also got to trailing stop level. And what does that mean? That means now if I have a close below previous bar's close, I'm going to get out of half. That happened here on the 4th, closed below the previous bar's low, got out of half of the remaining shares at $8.74 for a gain of 4.81%. And then next day continued down. Then we moved up the next day, more profit targets, moved up again, more profit targets. Then we had this huge move up here where I can't remember how many profit targets I hit. I think I hit 6, maybe 7, took off into that strength. And in addition to that, on this day, we went above the 70 RSI, closed below the 70 RSI. That is a signal to get out of half of the remaining shares. And so I got out of half of the remaining shares at 1041 for a gain of 20.25%. Pretty good, right? I mean, that was absolute excellent day. So after I reject the 70 RSI, if I have a close below previous bar's low, I'm going to get out of half. Or if it closes below the 5 EMA, I'm going to fully get out of everything. So we move back down, on the next day here, or on the 13th, we had another big move up. I hit another 2 profit targets, took those off into the strength. And then finally here on the 18th, we had a first close below the 5 EMA after reaching 65 RSI level. That got me completely out of the trade and the remaining shares for a gain of 14.12%. So I am completely out of Walgreens. What a great trade. Again, using the bullish order block and the confluence of signals with the V1. So great trade here. All right, that's WBA. AGQ. Okay, losing trade, but again, you'll see the importance of taking the profits and the rules that I have of taking profits, exiting half. So I got long AGQ back here on the 27th of November. Why? This one, simple deep dip buy using the 200-day moving average. On this day, during the day, we touched the 200-day moving average, but closed above it, giving me a good risk to reward ratio. I got long $37. Position size correctly, placed my emergency stop 2 ATRs below. My end of bar stop is just going to be a close below the 200-day moving average. I put my 1.5 ATR trailing stop level up here, 39.60. Next day moves up, took some profits. Next day nothing. Next day moved up again, took more profits. Next day moved up again, took more profits, and I'm also in trailing stop mode now. Okay, so that means that now in the future, if I have a close below previous bar's low, I'm going to get out of half. Next day, didn't do much. And then here on the 6th of December, we had our first close below previous bar's low after reaching trailing stop level. I exited half of all the remaining shares that I had for a gain of 5.37%. Next day, huge gap up. I hit 3 profit targets on this day. You see how important it is that I took those profit targets here? Look where it is now, right? So you can see selling into that strength was really important. Next day didn't do much. Here on the 11th, more profit targets right at the top, and then we had the huge sell-off. I had to get out on the 18th because it closed below the 200-day moving average, and I got out of a loss on the remaining shares at 5.14%. But did I lose 5.41% on the trade? No, absolutely I did not, because again, taking the profits when the market gave them to me, having the rule of the trailing stop level, I exited half of everything here and then more here. And then, yeah, I mean, still, this is no fun, but you can see the benefit of taking those profits and having those rules, especially when the market just reverses on you like this. So the remaining shares here on AGQ down 5.14%. Let's go to LMT. Well, LMT, another losing trade. I got in here on the 12th, 12/12 at 497. Why? This is a little unorthodox trade, but really this is a channel trade where I have this swing low, connect those lines, draw that out into space. This should be where we bounced. In addition to that, we also went under the negative third ATR channel here, closed back above. That's why I took the trade, 497, placed my emergency stop 2 ATRs below. My end of bar stop was simply a close below this trend line. Trade never had a chance, never got going, never hit any profit targets, nothing. And I did have to exit the trade on the 18th of December for a loss of 2.95%, unfortunately. But that's just, it was a decent signal. The confluences were there. This one just didn't work out. So when I had the loss, just got to buck up, take the loss, get out, loss for 2.95%. And then last but not least, on the dailies, Caterpillar. This was a short position, and this was an island reversal. Go to my YouTube channel. You'll see a video, Island Reversals, Abandoned Babies, why they're some of my favorite new strategies that I use. But let's talk about what an abandoned baby is. I'm sorry, what an island reversal is. Let's go here into the red box here. What is this? Well, this is called a bearish island reversal. So what's bearish about it? Looks pretty like it's up high. Well, it is, but look here. The day before the first bar in the red box, we gapped up, really gapped up. There must have been some really good news. The sentiment was very, very bullish. Then the next day didn't do much, but then the key day was here on the 8th. when we gap down. So we went from gapping up, moving sideways for a day, and then gapping down. Why is that important? It just means that the sentiment went from very bullish to suddenly very bearish. And when that happens and you look out into the future, more times than not, you're going to see the price down. This is exactly what happened. But I did not short it here. I could have shorted it here, but then it would have gone my way and then it would have gone against me. What I did was I waited for a rebound in the stock to test the low of this abandoned baby. And I didn't get short here because it didn't reject. It didn't reject this low. It kept going up, 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 up. But then finally here on the 2nd of December, we went into the bearish island reversal and rejected it. And that's why I got short here 402.30. Now, on these particular trades, I simplified these a little bit. On abandoned babies, island reversals, I simplified these, and I have two outcomes of this trade. So I got short here 402.30. I placed my 2 ATR stop above, and I placed my 4 ATR profit target below. So in this particular case, one of two things eventually is going to happen. It's a certainty. I'm either going to take a 2 ATR loss, or I'm going to take a 4 ATR profit target. That's asymmetrical risk. I'm betting 2 to make 4, but in my experience on these island reversals and on these abandoned babies, they tend to go my way about 70% of the time. They tend to go against me about 30% of the time. But think about that. If you're making 4 ATRs profit 70% of the time and losing 2 ATRs profit targets 30% of the time, the math works, right? Okay, so got short here, 402.30, 2 ATR stop above, 4 ATR profit target below, and went my way, went against me, and then it just collapsed. And on the 16th, I did hit my 4 ATR profit target for a gain of, what does that say? That's 6. Yeah, that's about right. About 6.28%. So I was very grateful that I had some short positions going into this week. So yeah, a gain of 6.28. And then it continued down, but it's okay. Hit my 4 ATR profit target. Okay, and so that's that. Those are the rest of the closed daily trades. So just recap, TLT, the remaining shares down 2.48%. WBA, the remaining shares I took off for a gain of 14.12%. AGQ, loss of 5.14%. LMT, a loss of 2.9%. And then the short on Caterpillar up 6.28%. So those are the daily trades, both the open and the close. Let's go to the one weekly trade that I have. Unfortunately, I had to get out of this trade. This one did not work. This was Budweiser. Again, why did I get into a trade? Okay, this is one of those bullish order blocks, and we go all the way back in time, all the way back to the 6th of October. It was your lowest bar close before market structure change. I was very patient, waited for it to come back into the bullish order block. These are weekly bars. And I did get long last Friday with at 53.43 because 1, we're in the bullish order block, and 2, we have a V1. Bar 1, bar 1, bar 2. Bar 2 goes below bar 1's low, closes above bar 1's close. That was my entry signal in addition to being the order block. Got long 53.43. Placed my emergency stop 2 ATRs below. My end of our stop was simply a close below the low of the order block at 51.10, and it certainly did close below it. So this one I had to get out, unfortunately, for a loss of 6.45%. So yeah, rough week for the bulls. Really rough week, and I can't control the market. You can't control the market. All we can do is come up with our strategies, come up with our levels, But what makes you a good trader is not whether or not you won or lost on a trade. It's whether or not you stuck with your process. And I stuck with all my processes. They just didn't work out. But thankfully, I had some shorts in there, which does work out. And we'll see next week. I mean, after this big sell-off, there are some buying opportunities, and we'll go through those when we get into the trades for next week. So anyway, like I said, I hope that was helpful seeing the trades. Wish they were all positive, but they weren't. But it's a good teaching example of showing you what you have to do when you have big sell-offs and the importance of getting out. Okay, before we get into next week trades, let's talk a little bit about trader psychology, and then we'll get into next week's trades. Okay, so this week's trading psychology quote came from Stephen Goldstein. You can follow Stephen at AlphaMind101 on Twitter. Stephen is a world famous trading coach. He has a great podcast every week called the Alpha Mind Trading Podcast, where he interviews traders from all over the world, from retail traders all the way up to hedge fund managers. And I have been fortunate enough to be interviewed twice on Stephen's podcast. But please follow him, Alpha Mind 101, and he has a lot to teach. You can learn a lot. So please follow him and check out his content. Let's see what Stephen has to say today. In trading, the markets aren't the problem. They are merely the terrain you must encounter. The problem is your ability to maintain focus, stay in control, and stick to your process as you navigate and fight your way across the terrain. So the market is the terrain. You need to manage the terrain. The market is not the problem. The most important thing is exactly what Stephen just says. You need to stay in control and stick with your process. I say this every week. Create your plan, follow that plan regardless, whatever it takes. That's the only way to success in trading long term, is to have a good trading process, good risk to reward ratio, multiple confluences of signals, and then follow your process, whether it goes up or whether it goes down. You have to have if-then statements, everyone. If it does this, then I'm going to do this. If it does that, then I'll have to do this. For me, if it goes down, hits my emergency stop, I'm out. If it goes down, closes below my end of bar stop, I'm out. If it goes up, the value of 0.45 ATRs from every day's close, I take something off. If it gets to trailing stop level, then I go into trailing stop level. If it rejects significant overhead resistance levels, I'm out of the trade. That is my process. It works. I've done it for 29 years. But whatever your process is, that's fine. The important part is you have to stick to the process. So let's one more time. In trading, the markets aren't the problem. They are merely the terrain you must encounter. The problem is your ability to maintain focus, stay in control, and stick to the process as you navigate and fight your way across the terrain. Make sense, everyone? I hope it does. Hope that's helpful. And thanks, Stephen. Appreciate you, and hope you're doing well, and happy holidays in case you're listening. Okay, let's head over to the potential trades for next week. Now, I mention this every week, and it is possible that all of these particular signals could happen on Monday, for example. What do I have here? I have 16 symbols. Does that mean I'm going to take all 16 of these positions? No. Even if all 16 of these trigger on Monday, I'm going to narrow it down to the best one. How do I do that? Well, which one had the most confluences of signals? Which one had the best risk to reward ratio? Which one looks better on higher time frames? Which one has the best or weakest relative strength compared to the rest of the market? It's important. It's basically like giving a score, a report card to each trade. If one has one entry signal and another has two entry signals, well, obviously I'm going to go to the one that has two. But maybe the one that has two doesn't have a good risk to reward ratio. Then I have to look at something else. So it's the combination of how many signals, the risk to reward ratio, what it looks like on multiple time frames, and then the relative strength or weakness of that particular market. And that, again, is what I teach my students in my one-on-one course. So if you're interested in learning with me, having me teach you one-on-one, I'd love to do it. You're going to learn a lot. And also, by the way, if you like online courses, I have a great online course available at udemy.com. The link's in the description. I teach 7 different strategies in my one-on-one course, but the online, I only have one at the moment, but that's the deep dip buy. Great course, 9.5 hours of video, 26 videos total. And I have sold so many of those around the world, and I think I have a 4.8 or 4.9 out of 5 stars on that. And I get emails and messages all the time. Greg, I really like this online course. I learned so much. So if you're interested in that or the one-on-one course, just check in the description. I have all the information down there on either. So let's get started on ARK. Here is ARKK. Well, ARK, right now, I am looking for a short. Why? Well, look here on the 16th of December. Here is our highest up bar close before market structure change. The market structure change came on the 18th when we closed below this previous bar's low. Really, all this is saying is that clearly we were in an uptrend, but technically speaking, the uptrend ended on the 18th with this bar because we took out this swing low. So if you go from a bullish market structure to a bearish market structure, then you want to short rallies. Well, this is what I'm looking for. I am looking for a rejection of this red box, either the bottom of the red box, the top of the red box. In addition to that, look at this trend line here. This trend line, we broke the trend line to the downside. Now this trend line is resistance above us, and that resistance of the trend line comes into the order block. So that's the thing I want to say. You know, last week, and I'll go through the SPY and I'll go through the Qs, but on that big down bar day on the 18th, that changed market structure. Are we going to go back up and make new highs? I mean, it's possible. I don't think so, though. What I'm looking for, really, I'm looking to short any rallies. And yes, we were very oversold. We were due a rally. We got it on Friday, but be careful. I know we are, over the years, we're used to every big correction being immediately reversed and going back up. I don't know if that's going to happen. I don't know. It's possible it can. I mean, it's definitely possible, but I think it is less likely. So that is why I'm turning my attention to getting short. So for ARK, I am looking for, so the order block here, the high is 63.14, the low is 61.48. What I'm really looking for, first of all, is rejection of the order block. I'm looking for rejection of 61.48, just like on Caterpillar. Remember the Caterpillar? No, not Caterpillar. Sprout Fresh Market. It's exactly. This looks exactly like Sprout Fresh Markets. Here, let's look at Sprout Fresh Market. Look, we have a high. We broke market structure to the downside. Yes, there was a little bit of a rally before we came all the way back down. Now let's look at ARK. We're an uptrend, break structure to the downside. Yeah, I'm not surprised if we have another 2 or 3 day rally, but I would be looking to short that just like I did on Sprout Fresh Market. So that is definitely an option. A rejection of the low of 61.48 potentially. Could go higher, but the next level I would look at would be a rejection of the high at 63.41. Let's go to Alibaba. Alibaba, all right. Well, this would be a deep, what I'm really looking for here on Alibaba is I'm looking for multiple things. Here's the 200-day above us. We broke below it. Not good news for Alibaba. But if we, next week sometime, we close above the 200-day moving average, I would consider getting long there. If it gaps up on Monday for whatever reason, then we have an abandoned baby. Here's an abandoned baby here. Look, gap down, followed by a gap up. Was it correct? Yeah, nice tradable trade in there. So we could have a confluence on Alibaba on Monday if it gaps up and also gaps up and then closes above the 200. That would be a nice confluence. That would be a bullish abandoned baby and a close under, close over the 200-day moving average. So that is an option to the upside. However, if we go lower, there are also some options key levels below us, the 250-day moving average, the 300-day moving average. They're kind of close here together. This is a deep dip buy. So right now, we are kind of in purgatory on Alibaba. It either needs to get above the 200-day moving average to potentially get long, or it needs to go lower and reject the 250 or the 300-day moving average to get long as well. And in addition to that, take a look at the lows here. The lows back here on the 22nd, look at the deep red MACD bars, very deep. Now look, we are lower here than we were here. No, well, a little bit of red MACD bars. This is called a double bottom with a bullish MACD divergence. So this is setting up for a really potentially good trade, but I still need it to reach either go lower or higher. If we closed above the 200-day moving average, that would be the confluence, would be a close under, close over the 200-day moving average, and a double bottom and a bullish divergence. That's a good setup. Doesn't mean it's going to work, but there's more of a chance that it will work than not. Or again, going lower and testing the 250-day moving average or the 300-day moving average. But even if we went lower and tested those, we'd still have a beautiful double bottom bullish divergence in place. So Alibaba's pretty interesting. CCJ. All right, CCJ is Cameco Corporation. Pretty simple, deep dip buy. Here's the 200-day moving average at 48.83. Right now we're at 52.44. Are we going to go down there and test that? I don't know. It's possible, but this is what I'm talking about. Identifying the level that makes sense to you. To me, this makes tremendous amount of sense, but I don't know if it's going to get there. If it gets there, great. I'll consider taking the trade. If it doesn't get there, then I just move on to something that does get there. But the confluence here is not the real point here is not just the 200. It's that previously, do you see the gray line? The gray line crossed over the black line, the 50 moving average crossed over the 200-day moving average. You've heard me talk about this multiple times in the past. If you have this is called a golden cross, when the 50 crosses the 200. If you have a golden cross, which we did, the first move back to the 200-day moving average, it's good. That's a good setup. That tends to work a lot more than it doesn't. So this has happened, but it has not come back to the 200-day moving average. So if it does come back to the 200-day moving average, one, it's just a deep dip buy, but to sweeten the deal, we have this golden cross previous. So that's what I'm looking for on CCJ, is a move back to the 200-day moving average. But again, don't know if it's going to get there. DoorDash, DASH. All right, well, similar to Sprout Fresh Market, similar to ARC, same thing going on here. On the 16th, we had the highest up bar close before the huge market structure change on the 18th. It's changed everything to a downtrend. Yes, after downtrends, you can have initial counter rallies before you continue lower. And this is what I'm waiting for. So I am waiting for a rejection of the bottom of the order block, the low of 175.04, or a rejection of the high of the order block at 179.75, or look at the trend line. The trend line was broken. Now the trend line is above us as resistance. If it rejects the trend line, I could also get short there as well. So just to recap, we changed market structure to the downside. There's a bearish order block above us. My options here are rejecting the first rejection of the bottom of the order block at 175.04. Alternately, if we go higher, reject the trend line. That would be another short entry. Or the third option would just be the high of the order block at 179.75. FXY is the Japanese yen. All right, look, we had a bullish baby. What's a bullish baby? Banded baby. We gap down, followed by an immediate gap up. Could I have gotten long here? Yes, I could get long right here, but on these abandoned babies, what I'm looking for is after the abandoned baby happens, I'm looking for a pullback to the top of the abandoned baby and a rejection. The top of the abandoned baby is 58.77. It's pretty close, so if we have a little bit of a sell-off on Monday, come back, reject the high of that abandoned baby, 58.77, then that's a potential long. And in this particular case, the way I would manage it is I would put a 2 ATR stop below and a 4 ATR profit target above. Let's take a look over here. Look, here's another abandoned baby right here. Look at that. Oh, I took this trade. You remember? We gapped down, we gapped up. I waited for it to come back and test the top, which I did there, and then have the nice move up. It's the exact same thing here, everyone. So I'm looking for a rejection of 58.77 potential entry next week. INDA. Wow. That thing never went down until it did. I've been watching INDA for years. I mean, look at this move up. Just unstoppable. And now everybody wanted it. Now nobody wants it. So what I'm looking for in INDA, right now this second, I'm just looking for it to move down lower. It's about the only place I'd be interested is at the 300-day moving average, 52.44. Right now it's 53.42. So next week, if it comes lower, rejects that 300, I would consider taking it. And a rejection means either a bounce of the 300, an intraday rejection of the 300, or alternatively a close under the 300 and close over the 300. Don't know if it's going to get there, but if it does, that's where I'm interested. IWM really has gotten beat up. That's mainly because of interest rates. You know, IWM mid-cap companies are much more easily affected by interest rates than larger caps. This is simply a 200-day deep dip buy, but the key here is that 200-day moving average coincides with the 6th ATR channel. It's hard to get something to go with the 6th ATR channel, and about 98% of prices do bounce at the 6th ATR channel when they get down there. And this just so happens to be the 200-day moving average and the 6th ATR channel at the same time. So if we do come back down and reject that 200-day moving average, I would consider getting long IWM. Coca-Cola, KO. Well, Coca-Cola has gotten significantly beat up. A lot of these value stocks, a lot of these kind of defensive stocks have really gotten hit. What I'm looking for potentially on Coca-Cola is the 300-day moving average. The 300-day moving average is 61.59. You can see last time we got down to the 300, it's almost exactly where it bounced. So potentially coming back down here, I would potentially get long Coca-Cola here. Microsoft, okay, well, what I'm looking for on Microsoft is the same thing that I was looking for on, which one was it? Was it Alibaba? No. Cameco? No. Which one was this? Oh, no. Yeah, Cameco, because we had the golden cross, the 50 crossing over the 200, and then waiting for a move back to the 200. Well, it's exactly what's going on with Microsoft. Look, back here on the 12th, we had the 50 cross over the 200. Okay, that's a golden cross. Long term, that's strong. But when the 50 crosses over the 200, I'm looking for a pullback to the 200. Well, this is what's going on with Microsoft. So I'm looking for a potential buy on Microsoft next week if we reject the 200-day moving average. And don't forget, we have the golden cross as well. That sweetens potential trade. Netflix, okay, looking for a short. Why? Here is your highest up bar close before market structure change. So when market structure changes to the downside, I want to short potential rallies. Potential rally levels for me would be the low of the order block at 923.08 all the way up to the high of the order block, 948.75. So you're not going to see me take this trade unless we reject the bottom of this order block or the top of the order block to the short side. Qs. All right, well, let's look at the index. You know, I think it was last weekend's podcast, I was mentioning that I thought the Qs looked toppy, mainly because of the three little Indians. Remember I was talking about the three little Indians? Look at this high, look at this high, run those two highs out into space. Here on the 16th of December, we made three little Indians, three symmetrical highs, high, high, high. barely closed above that, and boy, was that right? That was certainly right. We sold off exactly from them. But where do we go from here? Okay, well, we definitely changed market structure on the 18th because we took out this swing low. So if I take out the swing low, what am I looking to do? I am looking to short the rallies. I would short, now there's two potential places I would short the Qs here. The most obvious is going to be if we rally back up to the bottom of that order block. The bottom of that order block is 533. However, there is a significant level that we almost rejected on Friday. Look at the big down bar that we had on the 18th. If you have a big down bar and you rally back to halfway, you're going to find some issues there. Look at that. We almost got there on Friday. So really, I think we're going to have a bit of a tough time closing about getting up to 525. I mean, we may. Am I going to short it there? Probably not. But I just wanted to point out that big down bars, when you retrace 50% of the time, this is what's going to happen. So, but for our purposes today, what I'm looking for a short at the bottom of that order block, 533. Alternatively, if we come back up and reject the high of the high at 539.15, I would also potentially get short here. But I am definitely looking for a short on the Qs, but I'm just waiting for a little bit more upside potential. But in general, if we don't get there and we fail, we probably, excuse me, we will probably fail at about 525.60 because it is halfway at the big down bar at the 18th. But I won't take that short, but just want to point that out there just for some information. Okay, let's go to Shopify. Again, Shopify, like many others, we broke structure on the 18th when we took out all these swing lows. I'm looking for a short. I'm looking for another day or two rally back up. The bottom of the order block, the bottom is 114.95, or a rejection of the high, 119.85, or a rejection of the trend line that we broke to the downside, which is now resistance to the upside. SPY, very similar to the Qs. The 18th, I mean, we just demolished the market, broke all sorts of structure. So, yes, now, look, on this one, on the 18th bar, look, we literally got to halfway on that on Friday. Almost to the penny, we got halfway and then rejected it. So I am looking for a rejection of the order block back on the 11th at 605.50. Are we going to get there? I don't know. Probably not. But if we do, I would consider shorting the bottom of that order block. Verizon. Remember this trade? Holy smokes. I took this trade here back on the 12th with the rejection of the 200-day moving average. Had a great, wonderful, straight up trade. Got out here because my rules told me to get out of the 5 EMA. Now look, I mean, it gave it all the way back. Holy smokes. Holy smokes. But now I'm looking to get long again. Why? Deep dip buy. Look, we're under the 250-day moving average and we're at 29.44. So a nice confluence, very simple trade on Verizon would be if we close above the 250-day moving average next week, we will also close above the 30 RSI. That would be my entry signal. This one's pretty simple. If it closes above the 250-day moving average, which is above us, will also close above the 30 RSI. It closed under a major moving average and over a major moving average and closing under 30 RSI and closing back over a 30 RSI. That is one of the best signals you can get. So I am going to be very closely watching Verizon next week for that signal. Walmart has just gone up and up and up and up and up. But on Friday, we did break market structure to the downside. This is the first time we've closed below a previous swing low, putting us into a bearish market structure. I'm looking to short the rally. I'm looking to short the bottom or top of the order block. The bottom is 93.92. The top is 95.49. I don't know why I colored this green, because this is a bearish area. There we go. That looks more correct. So I'm looking at shorting this order block, the bottom or the top of this order block, because finally Walmart has changed to a bearish market structure. And last but not least is XLRE. This is real estate. Just got absolutely pummeled. Why? Well, because interest rates have gone higher. Are we at a level where I want to come in here and buy? Well, we're under the 200-day moving average. Would I buy a close back above the 200-day moving average? You know what? Right now, probably not. Why? Because of this big, huge bar here. Really, what I would be looking for here is the 300-day moving average. We did go under 30, over 30, which is a good sign, but there's a lot of supply. There's a lot of heavy weight here. I really want to be a buyer lower at 39.75. So if we come back down next week, reject that 39.75 level, could potentially get there. Why? Well, look, the 300-day moving average dovetails exactly with the -6 ATR channel. So this is the area that I would be looking for. So those are the dailies that I'm looking for. You can see in general, I'm looking at buying some really sold off potential markets, or shorting rallies in some of the ones that have been going up because we changed market structure. So, okay, let's look at the weeklies now. AMD, this one's pretty simple. Weekly bars close on Friday. So by next Friday, if we go lower, reject this 200-day moving average, I would certainly consider getting long there on AMD. Pretty good opportunity. Doesn't mean it's going to be a positive or profitable trade, but anytime a big company like AMD rejects a 200-day moving average, especially on the weekly, I would consider getting long there. GDX, gold miners, same thing. On the weekly 200-day moving average is below us, and we had a golden cross, the 50 crossing the 200. So after the 50 crosses the 200, the first pullback to the 200 is generally a pretty good place to buy. So I'll be looking there for each weekly rejection of the 200 next week. Johnson & Johnson. Okay, well, we are at a pretty important level on Johnson & Johnson. Look here, from April until July, this was the buyable area. You can see last time we rejected the 300-day moving average, turned into a nice buying opportunity. Well, this week I was actually looking at this on Friday, but see how we closed below the 300-week moving average? So next week, if we close back above the 300-week moving average, I will consider buying there. Let's go to Merck on the weekly. Pretty simple, 200-week moving average. Last time we got to the 200, buyers came in and we rallied. Will it happen this time? I don't know. It may not, but the most important thing is I need it to first reject the 200-week moving average. But what I also like about that is see how the -3rd ATR channel is dovetailed right there with that. I like that a lot. So I consider getting long Merck with the rejection of the 200-week moving average. Back to Verizon. I like it on the daily very much. Let's take a look again. Under the 250, under the 30 RSI, but if it closes back above, I'll take it on the daily. If it goes lower, then a rejection of the 200-week moving average would make sense. Again, we had the golden cross. We had the 50 crossing over the 200. When that happens, the first pullback to the 200-day move, the 200 makes sense. So if it goes up a little bit, I'll consider taking it on the daily. If it goes down a little bit, I'll consider taking it on the weekly off the 200. And then last but not least, XLV, healthcare, really gotten hammered, really gotten slammed. Very simple, just a simple deep dip buy here if next week, if we reject the 200-day moving average. Woo, I feel like I've been talking for 7 hours. Anyway, everybody, I hope that was helpful this week. The trades that I took, how I took them, how I managed them. I hope that the trading psychology portion was helpful for you as well. And I hope that these potential trades for next week were helpful. If you have any questions about anything in this week's podcast, please write them in the comment section. I'll do my best to answer them for you. Again, if you'd like to study with me one-on-one, I have the 15-hour one-on-one course. just email me. We can have a Skype call. If you're interested in the online course, it's at udemy.com for the deep dip buy. That's in the online course. But I hope you have a good rest of your weekend, everyone. Please try to go out and do something nice for someone every day. If you could go try to do something nice for an animal every day, that would be great as well. Animals appreciate acts of kindness just like humans. But holidays coming up. I hope you and your family are doing well. I hope you enjoy the rest of your weekend, and I'm certainly planning on doing that as well. But thanks for your time. Thanks for your attention, everyone, and hopefully it was helpful for you. Take care, everyone, and God willing, I'll see you next week. Bye-bye.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.